and in this brave new world that we're in. So everybody will be forced to mute. And so we're going to do our best to get through the business that we're required to get through. Let me just say it that way. And let's start by calling the roll. So Christina, can you tell us who's here and if we have a quorum, please?
Yes, ma'am. For the record, the following members are present for the Investment Committee meeting. Chair Elizabeth McCoy, Trustee Joe Bowen, Trustee Michael Christian. The following community advisory members are also present. Bill Britton and Quint Petro.
Okay, thank you, Christina. So the minutes of our last meeting were included in director's desk. So we need a motion and a second to approve the February 2020 minutes.
So moved.
We need a second. Somebody? So Joe made the motion, but we need a second. Mike Christian, will you second? Oh, Cammy. Okay. No. All right. All those in favor, aye. Motion carries. So I want to start out by thanking
Christina. I'm here, Myra Tobin.
Welcome, Myra. So I want to start out by thanking Todd and Nancy under Dr. Monday's leadership for all the work that has been involved in the investment arena since we last met in this most uncertain times. Todd and I've talked, I don't know, any number of times. I've been on some of the calls that FEG has hosted, which have been fantastic, Becky. And we spent a lot of time reducing our agenda today to just absolutely the bare minimum of what we thought we needed to cover. But please, at the end, if you'll feel free to ask questions, that would be great. And in the meantime, I'm going to turn it over to you, Todd.
Thank you, Chair McCoy. So as usual, we'll start out with a quick update on our asset allocation as of the end of the first quarter. Maybe before I dive in here, I would just start with a reminder. I know we've all been in touch since that last meeting, given the nature of the markets and some periodic updates that we've shared. But clearly, over the years, we've discussed the value of having the diversified, resilient portfolio that's able to withstand a number of market environments, including a severe market sell-off, such as the one that took place since that last meeting. So you're likely aware that the longest bull market in equity market history ended since our last meeting. So March 12th was the end of the S&P 500 index bull market. So something that we knew would happen. Obviously, nobody could foresee that it would be a pandemic that caused the market to sell off. So clearly this has been just a staggering time, terrible loss in terms of human lives and employment, and we're still in the midst of this situation, but pleased to report that the diversification that the committee worked hard to put in place really did serve us well in the period. You can see on page 7 here in Director's Desk, as of the end of the first quarter, a positive takeaway to me is really the fact that we remain balanced across the 4 asset categories that we have in the portfolio. So that was the result of some rebalancing that we did during the period. And we discussed that on calls that we had fairly recently here with each of you. And so it's really going back to our playbook. So we're sticking to our long-term investment plan that's laid out in the investment policy. What you do in the crisis period, you sell some of your winners. So we took some gains from our high quality fixed income portfolio, shifted those into equities during the period, which, as you know, we had a couple of the largest equity market sell-offs in history. And that was beneficial for us to maintain that balance. Just to speak briefly, and I know FEG will talk about the markets, so I don't want to go too far here, but again, just speaking to just the incredible coincidence in the timing since that last February meeting on February 20th. That was really when the markets had started to turn. So we just briefly discussed at the end of that meeting how the equity markets hadn't really seemed to respond yet to the outbreak of the virus. And clearly things happened very quickly after that point. So we've had 50 trading days since that February 20th investment committee meeting. We've seen bigger than 1% market moves in 42 of those 50 days. So again, just historic volatility and averaging 5% market moves in that month of March. So really at this point, our statistic is 47 days year to date that we've seen those 1% S&P 500 moves, and that already outpaces what we saw in calendar year 2019. Shifting to page 8, which I think just demonstrates some of the shifts that occurred under the hood in the period. Really the keys I would highlight here are the fact that our public equity exposure did decrease, as you would expect in a period with such a large equity market sell-off. I would say that it decreased less, given that we did add back to that exposure during the period, as I just mentioned. Hedged equity actually did provide some nice protection relative to the long-only equity markets, so that held in fairly stable. On the private equity side, we did see that increase, and that's a couple of reasons behind that. One is just the fact that the valuation of those funds is lagged, so we won't see the reduction through 331 for some time, but there still were some capital calls during the period that account for some of the increase under the hood in that global equity bucket. Overall, as I mentioned, fairly flat in fixed income, which is really, another interesting attribute, the fact that we were able to take some gains and still see the resulting quarter end exposure be pretty much flat. So pleased to see that. In real assets, we did see a reduction in the public real asset portfolio, as you would expect. That's another space that really did see large price declines in the commodity markets in particular. And also we did see some increases in the private real asset side as well there. Again, some capital call activity as well as a lagged market value effect. Maybe one more comment just on our rebalancing activity, just a little bit of color on how we did it and why we did it the way we did. So as we discussed recently, we did a series of 4 Russell 1000 index purchases over the latter half of March. We decided to break those into 4 pieces, so 4 pieces in $5 million increments. The reason that we did it that way, and in frequent conversation with FEG as well on this strategy, is just the idea that, as you can imagine, it can be very uncomfortable to buy equities when you're seeing market declines of 9% in a day, for example. This is a technique used by many professionals in the market. You break your desired purchase into pieces. That way you make sure you're actually implementing and moving towards your targets, not trying to do it all at one time. A risk would be if you said, okay, well, I will buy in the future, you fall the risk of waiting for the bottom, and really nobody can make that call. So just a little color on our activity. Going over to page 10 here, just spending a minute on this. The numbers I realize are quite small. Just the top level, I just wanted to revisit the idea that, as we discussed at the last meeting, we added a little bit more detail on our policy ranges for the portfolio liquidity tiers that appear in our investment policy. And so our liquidity remained in good shape despite the market moves in the period. As you'd expect, our most liquid allocation did reduce given the market value decline and performance in the markets. And we did see an increase in the private market percentage of the total. But again, that's kind of a skewed impact given that the valuations don't flow through yet on those. But we still remain well within the guidelines in our investment policy. And one important thing, and we discussed on our individual calls in the past month or so, Nancy Rohde and I in the investment office have spent a great deal of time drilling into our portfolio liquidity. We've done liquidity analysis to really understand what we own, and this was done before the crisis happened. And we did some stress testing to kind of estimate what we might experience in a severe market sell-off. And so again, I feel like that was just great timing and helped to gain confidence through the sell-off that we were still in good shape. Any questions before I move on here? Okay. Going over to our manager appointments, a positive message to relay here as well, just in the context of business proceeding in the investment office and our work to continue prudently managing the endowment portfolio. So as opposed to us being on our heels or caught off guard in the market sell-off, we were actively monitoring the portfolio, and we did make some new investments and commitments during the period. So these are outlined as usual in the FEG memo as far as the investment thesis, but we made a commitment in diversifying strategies to a really interesting fund managed by a portfolio manager that I've tracked over the past 15 years, predating my time at UK. Really excited about the public credit investment, and I discussed this when we connected recently, but the idea here is we've been waiting for an opportunity to make this allocation for at least 4 years. And at the February committee meeting, Keith Berlin outlined our entire fixed income portfolio and also discussed the idea that when the time was right, we would step in and make this investment in the high yield fixed income market. And we got that opportunity given the market sell-off. So we funded that investment from our public credit portfolio, and it just allowed us to diversify even more within that area. Finally, in private credit, that is an investment that we began research on in 2019. And we proceeded, obviously, frequent conversations both with the investment manager and FEG in terms of, is this still the right investment? And we are confident, given our liquidity profile, that remained a compelling opportunity and actually an even more interesting investment opportunity given what happened in the market since 2019. In terms of terminations, the only one to highlight here is an active decision on our part. So we, as you know, we've had some passive exposure in the public real asset portfolio. And we decided, given what was happening in the markets, we wanted to shift out of a passively managed REIT index fund from Vanguard. We shifted that capital to an existing fund managed by PIMCO. It's called the EarMath Fund. And the idea there is, given the sell-offs that we've experienced in the REIT market in particular, we wanted to have active management of those assets. So the EarMath portfolio, it includes a variety of inflation hedging asset classes, including TIPS, REITs, gold, and some commodities. And it allows the manager to actively manage those exposures. And within the REIT area in particular, it's an actively managed portfolio. So again, just trying to be thoughtful and intelligent about our exposures through this period. In terms of our due diligence, as you'd expect, it was quite a busy period given the state of the markets. One observation you could take from this is the fact, travel restrictions obviously mean that we were not on site with our managers, but rest assured we were on very frequent webcasts, Zooms, conference calls, et cetera. And so a variety of really good conversations here. Chair McCoy and I were able to participate in that March 18th FEG webcast. That was really, in the height of the sell-off and just a really good kind of calming tone in the message from that webcast and just kind of framing some historical elements of other sell-offs relative to what we were experiencing. And so they have a couple slides on that they will share today. Only other updates, I would just mention again, the fact that we did continue our due diligence. So we had an artisan, that's the investment manager that we ended up hiring in high yield. That was March 25th. So again, a case where we had done our research to evaluate that strategy and then subsequently decided to make the investment. So really, that's the extent of my prepared comments. I'll pause for any questions.
Anybody have a question? All right, good job. Todd's been busy, as you can see. All right, if there are no questions, then we'll move on to a report from FEG, and we're glad to have Becky and Mike with us as usual, so I will turn it over to you two. Mike or Becky? There we go.
Can everyone hear me now?
Yes.
Yes.
Okay, I've called in through my cell phone, hoping that the audio would be better. But as long as everyone can hear me without an echo at this point, then that's great. And if I do start to echo or cut out, please let me know, and I'll change over. But first and foremost, it's great to see everyone, although via Zoom. I hope all is well with each of you, and that everyone, including your friends and loved ones, are healthy at this point, given everything that's happened over the last several weeks and months. I know that these are difficult times for a lot of folks, and the university specifically. So please let us know if there's anything that we can do to help. We FEG are here to help and be an extension of staff. So please reach out if there's anything that we can do. These are very weird times. I can say that I've spent more time in my house in a suit for these types of Zoom meetings than I ever would have imagined historically. The amount of hours is up tenfold than probably what it was. And you can see that if you're on the camera, my hair is getting quite long. My wife has offered to cut it, but we've been spending a fair amount of time together, so I've been hesitant to have her standing behind me with sharp objects at this point. But I look forward to hopefully here in the near future getting a chance to come back to Lexington and having a lot of this behind me. But before we jump into the materials, I thought it may be helpful just to give a brief update on FEG, just so everyone is aware. As you may have expected with the stay-at-home order that was put in place in Ohio, everyone has effectively been working from home, and it was a very seamless transition for the most part. I mean, a lot of the consultants and analysts that had done some traveling would be able to and set up to do any of the work that they need to do from home at this point anyway. So technology has come a long way, which has made this a lot easier for folks in our business. Using a lot of Microsoft Teams, a lot of Zoom meetings. We have our standard Monday morning research team meeting via Zoom, and are continuing to do that, continuing to stay up to speed with all the investment managers that are on our recommended list, including continuing to research those out there that may be opening up for capacity that we may be interested in as well. So similar to Todd and Nancy, everything has moved to Zoom meetings and telephone meetings, but continuing to stay on top of the managers on our list. One other thing that I thought might be helpful, we had a few events scheduled throughout the rest of this year that I'm sure you can guess those have pretty much been canceled. We are planning on having some of the folks that were planning on presenting at an event that we had scheduled in Dallas to host an event via webcast, similar to the one that Todd and Trustee McCoy were able to join in March. So it's still ironing out the details there, but they should be the insightful topics on energy and some other markets that have been some of the big movers over the last several weeks. So more to come on that front. So moving on to page 17, key takeaways from this meeting would really be, number one, diversification was very valuable, as Todd mentioned, not only in preserving capital, but also getting the opportunity to move opportunistically and add money to some of those asset classes that saw some of the largest declines in the quarter. I mean, rebalancing is such an integral part of forecasting returns and actually having a strategic asset allocation in place. If you don't stick to it, then it's hard to ensure that the portfolio does produce the returns that you would like for it to experience. And that's exactly what happened in the last part of March. So you can see there were $20 million added to equity amongst the March volatility, as well as the $20 million that was added to high yield bonds. The game isn't over yet. The story hasn't been told. However, up to this point, those moves have been very beneficial, as there was a very sharp bounce back coming out of the second to last week in March. The other thing that we're really focusing on and making a big push for is trying to identify active managers across asset classes, really, that may have been capacity constrained historically, where they were turning investors away, saying, we just don't see enough opportunities out there. We don't want to manage more money because we think it's going to dilute the returns for our investors. Opportunities have opened up over the last few weeks, and we're continuing to knock on those doors to see if there's any interesting managers that could be potential additions to the portfolio. And that's an ongoing dialogue between us and Todd and Nancy, as well as the managers that are out there. In terms of looking forward into the rest of 2020, hoping that the June IC meeting is an in-person meeting and we have our portfolio risk review. I think it will be very timely. Following the risk review, we'll do our biannual, we do it every 2 years, the investment committee survey to help get a pulse for risk appetite, liquidity appetite, get a sense for how things are at the university, as well as getting some insights into what may be good topics for future investment committee meetings. And then finally, reviewing the asset allocation and the investment policy statement later in the summer, ensuring that those targets that we're working towards are the ones that will best position the portfolio to produce the returns that we're looking for. So moving on to page 18, this is showing the asset class or index level returns across really all markets over the first quarter of the year ending 3/31. So trailing quarter, 1 year, and 5 year returns here shown for these asset classes. Starting on the left, global equities, you can see equities produced anywhere from a -20 to a -25% return, depending on the geography of the investments. The trend of US equities being some of the best performers leading up to this drawdown continued through the first quarter, where it was more of a flight to quality, where domestic equities held up better than those international markets. Within fixed income, the Bloomberg Barclays aggregate is an index that is comprised of predominantly government issued bonds as well as high quality corporate bonds. Starting yields for this asset class have been very low. And we've had a good dialogue back and forth about the benefits of this allocation and how much should be held in this allocation. We were very pleased with the results from having a fixed income allocation to core bonds in the first quarter, helped preserve capital as well as helped to rebalance the portfolio back into some of those other asset classes. High yield bonds, we'll talk more about here in a future slide. Real assets, REITs, and commodities, down 23.4 and down 23.3. Performance pretty much in line with equity markets. The one area of the market that saw some of the most pain, as you may have read about and talked about, was the energy complex, and the Alerian MLP index is midstream infrastructure. So this is predominantly pipelines that are transporting oil and natural gas, and energy was really hit because of not only the demand destruction that came from economy shutting down worldwide and no one really driving. The only time I drive is to get my daughter to take a nap at this point. And then the supply shock of the Russia and Saudi Arabia in late March, not agreeing to production cuts, which basically flooded the market with supply, including the production that was going on in the US as well. So prices reacted very dramatically negative in the first quarter. And then hedge funds preserved capital better than equities in the first quarter, but didn't necessarily cover themselves in glory. So still an asset class that we are reviewing closely and will be a topic of conversation for future asset allocation meetings. So moving on to page 19, this was, Todd had mentioned this was really a snapshot of what was experienced in the first quarter, not only was the quarter a bad one just when you look at the one snapshot number of down 20 or down 25%, but the speed at which it occurred was really unprecedented. So this chart here shows the worst 10 days of stock market performance in Wall Street's history. And you can see this goes all the way back to the Great Depression. And you can see 2 of the 6 worst days in history occurred within 5 or 6 days of each other in the month of March. And so one point that I think is important here as we work with a number of other institutions, it was very beneficial and pivotal to have Todd and Nancy in place, given the dramatic sell-off that occurred, as well as the dramatic increase that occurred shortly after that. What you cannot see here is that the last week, I think it was ending March 27th, was actually one of the best weeks in stock market history. So the recovery was just as quick in some cases as pieces of this drawdown. And having Todd and Nancy in place, we were able to have very frequent dialogue, very level-headed and balanced dialogue around how the portfolio actually sat from an allocation perspective in mid to late March, and whether it made sense or not to rebalance back into the markets, given the declines that we're experiencing. It was not an easy conversation, but those moves that were made were beneficial up to this point. So thought that was worth adding. So I don't want to dwell on too much of the negatives. I'm hearing a bit of an echo. I don't know if it's just me. It's just me. Okay. But we have quite a few slides here that are framing the environment that we were in the first quarter. And again, we've seen a sharp bounce back, but I think these next few slides will provide a little bit of context around what was experienced and the results in previous periods where you've seen these types of declines. So this first chart here is really showing the rapid speed at which the decline occurred. So historically speaking, it's taken the market a number of months to experience a decline of over 30% or more. In the first quarter, this happened in a matter of, I think it was 25 trading days. So the speed was unprecedented, and I think this is a point that showcases that. My own speculation for some of the reasons behind this and some of that volatility that Todd had mentioned, the stock market in general, which I think everybody considers kind of the S&P 500 as a barometer for the market, is in somewhat of a unique space at this point, where the top 5 companies in the S&P 500, those FANGs and Microsoft, represent over 20% of the index. There are currently 300 constituents, so 300 other companies in the S&P 500 that represent less than 0.1% of the index. So in terms of the breadth of returns and where you're seeing the drivers of returns, it really is reliant upon those 5 or 6 companies for the market to move up or down. And I think that's exacerbating some of the volatility or increasing some of the volatility that's been experienced over this time. So I think that further supports having diversification away from just US large cap stocks, just given the concentration that there is at this point. But that is something that we'll have more dialogue about. More history here on bear markets, and as a reminder, a bear market by definition is a 20% decline from peak to trough. Historically speaking, these have typically lasted more than 1 year, although we are in a unique period where the cause of this is very known. The outcome is still uncertain and the result is still uncertain, but some of this has been brought on by the policies that have been put in place. So the chart here shows the duration in blue bars relative to that left-hand axis, as well as the bear market return relative to that axis on the right. So wanted to provide just a little bit of context around the fact that these have tended to last for longer than just a couple of days historically. But there is some additional uncertainty surrounding this event just because of the cause and the potential recovery coming out of it. So moving forward here to page 22, I think something that there's often a connection made between the economy and the stock market. And in reality, the economy sort of chugs along and the stock market bounces up and down with more volatility. And point being, not all bear markets occur during a recession. And I think it's a pretty high probability at this point that we are entering into a recession. The duration of that is still less certain. But with that being said, if you look back at historical periods where there has been a bear market in equities, that has typically coincided with a more severe decline out of equities, as well as a longer duration of that market environment. And so we've already experienced a 35% or more decline in the first quarter. But the other thing that I think is helpful context here is, you may remember back in 2008, the terms like quantitative easing and the other programs that were put in place to help support the financial system, the banking system, and the economy in general. What is less remembered is the amount of time that it took for many of those policies to be put in place. In some cases, it took months for some legislations to be passed and some support to be provided to parts of the economy. That playbook effectively made this a little bit easier on the federal officials that were in office, as well as the Congress in getting some things passed, to where it took a number of days for interest rates to be cut to zero and all of the stimulus to be pumped back into the markets. So this has been dramatic in both the decline as well as the response. And the impacts of that are something that I have some opinions on, but that may be for a later time if there are questions. Next slide here, this shows just what Todd mentioned of the volatility that's been in the markets, the number of trading days up or down of the S&P 500. So unless there are questions, don't feel the need to elaborate further on this one. Great. So moving on to the portfolio's performance, and then some slides covering the drivers of performance. So portfolio down 12.1% for the first quarter, slightly below the initial estimate that was put out there of 11.9%. We're still waiting on getting those private capital statements that Todd had mentioned. Portfolio slightly lagging the manager weighted index, which is really, it looks at every manager in the portfolio, what is the stated benchmark for that manager, and rolls that up to an aggregate level. So slightly lagging that on the quarter and some of the trailing time periods. With that being said, down 12% is one of the better numbers that I've seen from the institutions that we've worked with and the other groups that we talk to in the market. And on top of that, I think April will be a pretty positive month to the tune of really mid to high single digits, given the transactions that were made at a very good time when the market was close to some of its troughs. The things that really worked well for the portfolio in the first quarter was the allocation to hedged equity, protected capital very well, significantly outperformed peer strategies. High quality fixed income, as I mentioned, core bonds were a great investment to have for liquidity and for performance for the first quarter. Public credit was also an area of the portfolio that outperformed, protecting capital better than the index. So each of those doing very well. The things that didn't work well, these are things that we really have talked about at previous meetings, with that being an overweight to international equities, although that has been somewhat moderated over the last few quarters, and particularly value-oriented strategies, which we'll talk more about. U.S. small cap stocks underperforming, U.S. large cap stocks, which we view as almost an opportunity given the levels that we're seeing today. And then diversifying strategies, again, hedge fund, not an easy area to benchmark protected capital, but lagged the benchmark that was being used.
Hey, Mike,
Yes,
Trustee Bowen has a question.
sure.
Can you hear me?
Yes.
Okay.
Yeah.
So on the equity, I'm just curious to know on the hedge fund, while we don't have a very big position in hedge funds, and I get that, but does that include shorting the market any?
Yes. So the hedge deck. Can everyone hear me? Okay. Okay.
Yes.
The hedged equity allocation would include managers that are going both long and short individual securities in the stock market. Yes.
Yeah. Okay. There's some opportunities I would think there, but anyway.
In that, frankly, hedged equity has been one of the areas that has been, if you would have looked at this slide that we've been producing over the last few years, hedged equity spent a fair amount of time on the right-hand side of this slide as being one of the laggards. In the first quarter, this really opened up the opportunity set for these managers, and they knocked it out of the park. In the month of April, I think we're going to see even greater outperformance from the hedged equity portfolio relative to the peers and the benchmark that's being used. So the managers that have been included in this space have certainly seized the opportunity that's been presented.
Thank you.
Certainly. So drivers of absolute performance here, this is year to date, just absolute performance of the public investments that are in the portfolio. So we don't have the private marks yet, but can include them once we do have them. Effectively, this chart, I think, is a good visual of the benefits of diversification, highlighting long short equity, hedged equity, down less than 25% of what the broader stock market did in the first quarter. High quality fixed income, again, getting a positive 5% in a period where equities are down 20 or 25% is huge for the purposes of this portfolio. And then public credit and diversifying strategies, holding in better than equity markets. Public real assets was an area that we have some slides on talking about the performance that came from that asset class. But overall, still think it's warranted, especially given some of the things that have been put in the market today to hold public real assets. The primary reason for that is for inflation protection. And effectively, in the short term, I think deflation is the primary concern, but the potential, I think, longer term for inflation to kick in should support the allocation in that space. So one of the things we've talked a fair amount about is the value bias that is incorporated into the portfolio implementation within particularly international and emerging markets today. So favoring those more unloved, potentially underpriced sectors and stocks at the expense of some of those higher flying, more growth oriented technology stocks. And historically speaking, when reversals have occurred in markets, you have tended to see similar reversals in factor performance. That was not the case in the first quarter. And you can see that the performance differential between the IFA is international developed, that's basically Europe and Japan. The performance differential between value stocks and growth stocks was dramatic in the first quarter as well, with growth hanging in there very well relative to the value counterparts. So this is one driver of relative performance in the short term. Have another slide here talking about the rationale long term, but Todd and Nancy and FEG, myself, Becky, and some of our colleagues on the equity side have had some very good dialogue back and forth recently just about the overall exposure within the public equity portfolio. So more to come on that front. So this was the other chart that I was referencing. So as I mentioned, value has been a headwind for the portfolio more recently, and it is a logical question to say sort of why value, why favor being more price conscious in implementation in these international equity markets. And I think there will be periods where this does not work, as that's probably the most obvious statement given we're in one. But for an institution like this endowment, which is intended to be around for not decades, but centuries, I think focusing on strategies that work over very long time horizons seems like a prudent approach. And what this chart is showing is the performance differential. So stripping out the impact of the market, what is the performance differential between value and growth stocks? And over the long term, what you've seen is value has historically offered a pretty consistent and a pretty attractive premium by just being price conscious and buying cheap stocks. Whereas this time period that we've been in, it's been a headwind to the public equity strategy, which is one of the biggest allocations in the portfolio and is driving some of the relative results. So long term, still feel comfortable and with the overall positioning, and don't think value is dead, but understand that this has been a driver of relative performance more recently. So I'll move through these next few slides quickly, just in the interest of time. Fixed income performance here. The one thing I'm just going to point out here is the long treasuries. So this is long duration treasuries. The first quarter's performance was up 21%. Incredible performance for long dated bonds. But one of the reasons for that is the duration that's associated with those bonds and the magnitude of the interest rate decrease that we saw over the first quarter. So more to come on that once we hit the memo. Real assets performance, feel like I've touched on this as well. So happy to answer any questions, but effectively real estate has held in better than some of the other sub-asset classes within real assets, with energy and anything associated with energy being the primary laggard in the first quarter. Sorry, I just got an update for a question. I wasn't sure if there was another one or if that was the first one.
No, that was the first one. You're good.
Oh, okay, sorry. So hedge fund performance shown here. This is really to highlight the fact that hedge funds are a very different, or a very difficult space to benchmark. There is no stated S&P 500 index, or there's no stated index that includes all of the potential investments that these strategies can take, given that most of them have sort of an absolute return focus. The way that we benchmark them, and I think a lot of institutions benchmark them, is through peer strategies. So that's what these HFRI indices are, is they're just a peer group. And in some cases, it's not a very apples to apples comparison. There's also issues surrounding it's self-reported in a lot of cases. So sometimes you just see some of the best performers report. There's survivorship bias, meaning those funds that have wound down are no longer included. So all of this to say, hedge fund benchmarking can be a challenge at times and can lead to tracking error. I don't think that's something to dwell on. More hedge funds are going to be continually be reviewed for, are they producing the types of return on an absolute basis that we would expect them to produce, and the reason that they're in the portfolio of providing diversification as well as absolute returns. But thought this chart that just shows the dashed lines of sub-asset class, sub-strategies of hedge funds, as well as the solid lines of being the sort of all-encompassing portfolio level benchmarks, would be helpful to say, like, if you look, the benchmark that's being used right now is the HFRI Fund of Funds Conservative, which was down 4.9% for the quarter. Effectively, what that peer universe includes is a composition of all of those dashed lines, and there aren't many dashed lines above that down 4.9%. So don't feel the need to go into too much more depth on this, but it is one of the challenges with benchmarking hedge fund strategies. So moving on, next steps, things that we're continually talking about and reviewing with Todd and the team. Rebalancing is something we're continuing to dialogue about, given some of the 1% moves that we've hit on previously. Moves were made were very beneficial in the first quarter. Next, reviewing what others are selling. So we have a few slides here to talk about that. Avoiding selling at the bottom, which can be hard at times, and then finally investing for the future, looking at what sectors are going to be the ones that are going to be the winners over the next cycle. So in terms of reviewing buying what others are selling, the first area to focus on, and I know that we're somewhat short on time, is high yield bonds. So high yield bonds, as the name suggests, would be bonds for less than high credit quality businesses in the public markets. So historically speaking, I think this is a great visual for the opportunities from an entry point perspective, as well as the returns associated with some of those entry points. What this chart shows is the left-hand axis is the spread, so the incremental yield that an investor receives for lending money effectively to these weaker credit quality businesses. And historically speaking, that spread has been 5%, so 5.1 you can see is the average towards the right-hand side. The opportunities for attractive entry points tend to be when this spread is elevated and above that point. So we look for, I think Keith referenced at the February meeting, 800 or 900 basis points being an attractive entry point. And historically speaking, when you do see spikes to those levels, the forward returns from that point have been attractive to the tune of high single digits or low double digits, being higher in the capital structure than equities. So viewed this as an attractive entry point and made an allocation to one of the strongest managers in this space, in Artisan. The next area of focus of buying what others are selling was small cap. So we've talked a fair amount about this in the past as well, the huge divergence between large cap and small cap performance historically, where small cap has been absolutely trounced by large cap over the last several years, and that continued in the first quarter. With that being said, historically speaking, if you looked at previous cycles going into bear market territory and coming out of bear market territory, in a lot of these cases, and each one of those that is starred on this chart, small cap, micro cap, and mid cap have been some of the leaders coming out of this type of a market environment. So something that Todd and FEG and Nancy and I continue to talk about. There was an incremental ad at the end of March, and we're actually starting to see this pan out on the positive side. Last week, I think, was in the 99th percentile of observations for small cap versus large cap. So this can reverse course quickly, and hopefully that trend is starting up, and that would be beneficial for the portfolio. So MLPs are one of the areas that I've mentioned in the public real asset space, and one that performed dramatically negative in the first quarter given the environment that it was in. It would have been, I'd say, easy to pull the ripcord and just say this is the signs are pointing too much in the negative direction, and just no longer want to be exposed to the asset class. But a lot of the reason for the decline being as dramatic as it was really technical in nature. There's some ETFs that led to and exaggerated some of the declines in the market. So the portfolio is underweight the allocation, which helped going into the first quarter, but ultimately decided to remain invested through the month of March and continues to be invested today. On the positive side, MLPs are up now 100% from their lows, or they were at some point last week. So they have bounced back, and some of those technical factors have subsided. Whether this is a long-term allocation and the proper implementation is something we'll continue to review, but not wanting to sell something just because it's gone down, and that was another positive for the portfolio in the month of April. So all in all, think that the endowment is in very good shape and in very good hands. Continuing to have very thoughtful and productive conversations with the UK investment office on the public equity portfolio, the fixed income portfolio. We're talking about real assets and privates next week. And so all in all, looking forward to the future meetings on risk and asset allocation, but think that the portfolio is in good shape as it is today, but happy to answer any questions on any of the materials that was covered.
Thank you, Mike. Anybody have a question? Nobody's raised their hand, have they, Katie?
No, ma'am, not yet.
All right. Any other comments, Mike or Becky? All right. Thank you all as usual. And Todd, I'll turn it back to you.
Sure. Thank you. Maybe just I'll briefly reference, as I mentioned earlier, that FEG has a memo on some of those recent allocations, as well as just a minor guideline change that we made to our Reams Core Plus fixed income mandate, which credit to FEG, this was a proactive move on their part, really intended to maintain our diversification, but reduce our interest rate risk exposure a bit, given how low rates have fallen. So some good information there. And then I'm just going to scroll to the end of the materials here and highlight our meeting schedule. As
So,
you might have had, I'm sorry.
Todd, Quint has a question.
Okay, great.
Hi, everybody. Thanks so much, Mike, for that presentation. So a lot of us have been sitting in presentations like this, and we're hearing all about where the market was and where it is today, and we're all sort of feeling like, hey, maybe the worst is behind us. I take a completely different viewpoint. So in the event that we are far from the worst being behind us, are we doing anything to actually de-risk our portfolio here at this juncture?
Yeah, maybe I'll comment there. I guess probably the most important thing to say is that this portfolio was diversified following the last financial crisis. So you could say we did de-risk our overall portfolio by reducing our long-only equity exposure. We did that over the course of a number of years. So we entered this crisis in a very balanced and prudent allocation, I would say. So I think we're in great shape overall. I think the de-risking that I just highlighted was actually on the fixed income side, ironically, to reduce that duration profile just a little bit. Clearly we're paying close attention to the markets and what might happen on the other side of this crisis. But, from my perspective and from the perspective of a lot of our managers and folks smarter than me, the idea of being able to call the bottom is a really tricky one. And, our mandate is to remain diversified, obviously paying attention to what's happening in the meantime. But, I think our risk profile is really nicely balanced now between, public, private equity, and across credit and real assets as well. So I don't think we have a need to dramatically change our risk profile either to the upside or the downside.
And relative performance will not change that then?
So the relative performance in the first quarter, we added back a bit to our equities to get towards to where we were at the beginning of the quarter. So clearly market value adjustments, we'll want to make sure we steer back towards those targets. But yeah, I think overall, again, I think we've got a strong portfolio.
I just want to make sure as a committee, we're saying that the posture is that we're okay with our allocation. If the market goes down another 30%, we're okay with our allocation. So I'm okay with that, but I don't want to be involved, all of a sudden we see a significant further decline, and then we're looking at going, okay, how do we remove risk here?
Yeah, no, I think it's a great question and a great point. Again, I think, on the front end of this, coming into the crisis with, let's call it 31% in public equities, that's a pretty modest allocation from a risk perspective. So if we do see another significant decline, obviously we'll be in close contact with the committee and with FEG, but the market will turn before the worst news is out there. And so I think there's a risk of missing out on a turn as well if we were to be in cash, for example. But I do think it's worth mentioning, we still have a significant allocation in the high quality fixed income portfolio. We haven't just blown that out and kind of gone all in on the recovery. I absolutely agree. There's a lot of uncertainty still out there. So I think our allocation in high quality fixed income continues to put us in a good place to adjust if we need to.
Great, thank you, appreciate that.
You're welcome.
Do you have to make a comment about the meeting schedule? Otherwise, we need to wrap it up because it's 2:00.
Sure, only 10 seconds, just the idea that we had to shift our risk review back to June, and we're in the process of lining up our schedule for September, so more to come there.
Anybody else have a question? All right, thank you, everybody, and we'll stand adjourned.
Thank you.
We'll get started.
Good afternoon. This is Joe Reed. Pleasure to be with you this afternoon. I'm going to bring before you our UKIA Operation Adjustments and Dynamic Risk Assessment, which is known as our Global Risk Assessment. We normally bring this before this committee in May. In the June meeting, we talk about our work prioritization or the audit selection process, or what has been selected for the coming year. Prior to getting into our dynamic work plan, which plays well in this environment, we've been doing this for several years now. I want to take you through a couple of our operational adjustments that we've made during this COVID environment, like everyone else. With that being said, we'll proceed to the next slide. Before I talk about what we're focusing on, tell you a couple of things that are not, we have 9 services. There are a couple of services which we have paused right now. One is our training program. We are responsible for Fraud 1, Introduction to Fraud, and Fraud 2, Advanced Fraud. We normally do that about 7 to 8 times per year, each of those curriculum. And we do those in person. But because of this nature and the social distance, because of the social distancing, we have put that on pause. I'm getting feedback.
Joe, you sound fine to us. Maybe need to turn your volume down on your device.
Okay. I get the feedback. I get my words. They're coming right back at me.
Do you have more than one device on? Do you have like an iPad and a computer on right now?
No, I do not. Am I the only one?
Okay,
I'm hearing him twice too, Katie.
So am I.
Me too.
Same here.
Minutes. So hang on just a second. Joe, let's have you log off and come back in. And in the meantime, we will have Chair Barry ask for a motion and second for the minutes.
Thank you.
Sound good?
Yes.
Thank you. Chair Barry, we'll turn it over to you. Chair Barry, can you hear us?
Can you hear me?
Can't hear. Ah, there we go. We can hear you now. Thank you.
Do it. Eric, you want to? Has there been a motion? Made.
Second.
At this time, we will move to the reports. Katie, can you hear me now? Oh boy.
Okay, Joe, are you back in the meeting?
Yes, ma'am.
Perfect. We'll let you continue on with your report. Sorry about the difficulty.
No problem at all. Thank you so much. As we move to our operations and infrastructure changes, I want to note two things. We have 9 services, which I talk about frequently. 2 of those services have been on pause. Prior to the interruption, talked about the training. We do that in person because it gives the audience a chance to see us, to see that we're real, and we're just not there to react to some type of investigation or something like that. In other words, they can see us in a different light, opportunity to chat and work with the client. So that's one side. The other one is the unannounced or / surprise audits. Given this environment, we are not doing those currently, so they've been put on pause. We anticipate with this environment goes back to somewhat being normal, we will pick that back up because that is an important element of what we do. Now to what we're doing, you can see on the right-hand side of the page, we have put this on our website so our clients and the university understands what we're doing. So we have put that on our website, and that's the page on our website. As I talk about the left-hand side of the page, what we're focused on, the first one and number 1 is processes. So we talk about we're steadfastly focused on the university processes. So in this environment, you can imagine how our processes have changed with the infrastructure moving offsite, with the telework, if you will, with the regulations being updated. Now I want to go back to the previous slide, please. So it's one where where we stand as far as this environment, the second thing is our focus. On grant. Eddie, I apologize. I hear that feedback again. Does anyone else hear that, or is it just me?
I think it starts up, Joe, once the
I hear it.
co-host Senate comes up. Because I noticed the first time too, once a participant called co-host Senate jumps on, then you start to feedback.
Okay, we're going to mute everyone but Joe and see if that helps anything.
Okay, I'll proceed, Katie. Yes. At this point, it's one where our focus, the second, number 2, is our focus on research. And we focus on research because there's a few important elements. The research continues on campus, but all the infrastructure which supports research is now off campus telework. That's that can be research financial services, the home department, our legal services, and OSPA, the Office of Sponsored Project Accounting. All those things are now offsite. So we are focusing a lot on research, and that's the contract side. The third thing is offering consultation. With the processes changing and things changing temporarily, some of my partners have engaged us to take a look and see upfront if there's something that we're doing to mitigate the risk, to see if there's actually credence in changing the process, number 1, and is it as efficient and effective? The fourth thing on there is IT, going to the IT telework environment, making sure that information security is not exposed. We know we have we have a network that our University of Kentucky IT services actually responsible for, but we have a few independent organizations that are responsible for their own processing and applications. So what I'm saying is that we have applications that are run by units. So that's why it's important to us, that particular aspect. Investigations continue. You would think in this environment that would not be the case. But they do continue. The sixth and final thing is data mining. Katie, do you hear that?
No, we don't, but I believe some other trustees are. Hold on just a second. Okay, Joe, let's try it again.
Okay, thank you. So with that, we'll do our data mining. That's the last thing I'm gonna talk about on this page, where we try to work behind the scenes, and that's comparing one database to another. We have numerous databases on campus. And because of our access and our IT skill set, we're able to do that behind the scenes. And we do engage the client where there are exceptions. So this is just to give you a glimpse that there is work operationally that we're doing. As we proceed to the next slide, this just talks about the audit process. And here, the big thing on the right side of the page with reporting, that hasn't changed that much at all. The only difference is now, instead of having in-person meetings to communicate our audit results, we have Zoom meetings. On the left-hand side of the page with planning and field work, that has really impacted our operation, where we're no longer do one important thing, the walkthrough. We get an opportunity to observe the client going through the practice of performing the task or function for what they're responsible for. At this point, we can no longer do that. So we do work around that with ample documentation and some other things, but that's an important element that we're missing in this environment. As I proceed on to the next slide, this gets to our risk assessment process. And in this process, it's interesting, we normally refer to it as the global risk assessment. When we actually assign a project, then you get to the project risk assessment. But here we talk about the global risk assessment. And this is broken up into three categories. The first one, we talk about information and assign information. That is the input. Storing information, that is the throughput. And then deliverables, that is the output. So for us, most important right now is the input. During this environment, this is the only thing that's changed to our model. As we work through the next page, what we'll be able to see is that with the information, this is about the process. Because we work with the process owner, we're able to input the date of a process change and what has changed with it. So that allows us to keep tabs and keep apprised of what's happening in our particular university and also in the industry. So that is really helpful with our partnerships. As we proceed to the next page, we talk about events. And the event for us is not COVID-19, but the impact that it's had, i.e. online instruction. So it's not COVID, because it could be any disaster which is taking place. You know, cancellation of events on campus, the changing of the way we service our students at this point. So it's not COVID, it's the actual impact of that. So that's what we document in there, that concern or information. So as we work through it, we know what's happening. The last part of this information is the regulatory update as we turn to the next page. And here, that's in three categories where we talk about the first one being the federal or state, then you have the university, then you have basically the industry. And because of this environment, you can imagine how much that has changed. So we spend a large amount of time right now on this information piece to make sure it is accurate. We put that in our database and run it. As we move through the next piece, that gets us to, we're going to talk about throughput. And the throughput is the storing of information. And what's important about that is the fact that it's based on a criteria. So as we move to this, and that's, you see the store information. As we move to the next slide, what you're able to see is a template that we use. And the first column is the enterprise division. And again, we break our work down in 6 enterprise divisions, which are there on your left, the first column. The one that we hear a lot about is that where does research fall? The reason we don't have research on there is research does have one process owner, but it's the home department, which is responsible for the research and aiding in that, is throughout the university. So that's why we do it like this. And then we do research. We are able to put that in one particular one particular process owner. But this is how we do that there. When it goes across the top and you talk about the 6 enterprise, business risk factors or criteria, there's actually 7 there. The 7th one is management requests. Management requests is the 7th business risk factors, also the 20th component. And we'll get into that in a second. Now, each of these are scored based on the enterprise division. So this helps us put the criteria and actually score it as we work through it. The two I will go through today is academics and healthcare. So as you move to the next slide, you get a feel for how we look at it and how we've scored this for our throughput. On the academic side, we put, you can see on the bottom, the rating rationale, control environment 2, which is information systems managed independently, which in the academic arena, we normally have our IT personnel who report not to our centralized IT, but to their home office or the dean's office. So for that, we consider that somewhat of a risk. So that's why that is rated at 20%. So those things which you put in there are weighted a little higher than other things. The second thing is public exposure. There are numerous things there. One we noted here was that we service minors. And then you go to the external factors, and those are the regulations, and that's adherence to the SACS Commission standards. And again, you can see in this environment how that's changed. There've been a lot of exceptions. And for us, this becomes important as we put these things in there to know the date of implementation, the date it was executed, and the date that a new standard has come into play. So when we do that against each of these, for you take public exposure, they have 4 components against that. And we actually score that high, medium, or low. So you can see when we take the average, that's weighted a little bit higher. At this point, I'll pause and see if there's any questions thus far. Okay, with that said, I'll move to the next one, which is our UK healthcare. And here you can see how public exposure is rated higher than anyone else. And that's interesting. Then you got external factors, because in healthcare, it's highly regulated. So for us, we're able to adjust these as the environment changes. And so as the environment changes, we make adjustments. It's a fluid process, part of our dynamic work plan. The thing I want to talk about a little bit so you understand it is management requests. If you notice on the preceding page, it was 10%. This one is 7.5%. It doesn't mean that it's not important. What it means is that when someone comes to us and said, I believe there's an issue or concern with area X, that's fine, but we say, what is the problem? And then if they say the problem is that they're not adhering to regulation X, that has an impact on external factors, and that will go up as well. So it's not just the management response that's going up here or being a concern. It's the fact that it's impacting the other business risk factors. So when you think about someone coming to us with a request, it's the source and the validity of the information, which is more important than the source. As we move through the next slide, what that takes you through basically is our deliverable, which is the output. And for the output, there are 2 things that are critical here. One is the information package, which normally goes to our auditor. And the other is basically the risk assessment or the rating of our projects. And the rating is based on the applications, 1, units 2, and processes 3. So that's how we kind of rate it. And what I want to do is to give you an example of an information package so you can see how that looks. And this is on the next page. On this information package, no matter what the topic, the application is such, and I know it's hard to read, but I want to give you an example. So what we do in our database, someone may say, well, tell me about the business, the Gatton College of Business and Economics. From there, what we'll do is say, we'll run everything against the Gatton College and Business School of Business and Economics. And what you have on the middle page there is a table of content. And it has, on the columns above, it has page 1, and then it has down there the information pertaining to it. Then it has page 2 and page 3. Now we move to page 1, which is the 3rd page there. It has the information that's on there. You will note this information is not trended, is the actual unfiltered information that we have put in there. It is up to the information requester. In this case, it's all internal currently, which is myself or the audit staff when they're doing the project, to discern what is it telling, what is the information telling you. So again, this is all this information we have. So this is during our planning stage for the most part, and it gives the auditor the opportunity to get some information up front. As we proceed to the next page, this tells you about our risk assessment process. And here, this is what we approved at our June meeting. And because we have gone in and run another assessment, it tells us that those things which are in gray are still important, but not as important as the things that are not in gray. So these things still bubble up as number one things we have to look at. But for instance, the Family and Educational Rights Act, because of the changes, we have deemed that not as important as the other things. We'll just move those other things up. We're still focusing on our risk and our projects, but you can see how it kind of changes somewhat. When it comes to applications, still those things are critical for us when it comes to in-house server configuration and unit applications. So for us, when we run our risk assessment, it kind of dictates where we're going to put our work in generally. But again, when we go in and we do the project, we give the project risk assessment. I know I went through that rather quickly, and there were a few things with the pause and the stop and go, but that concludes my report out. Are there any questions I can answer at this point in time?
Joe, so I think we're ready for Chair Barry to introduce our
services. Penny Cox, acting treasurer with the University Financial Services, will
Okay, can you hear me? Okay, thank you. So on page 22 of your board packet are the materials that contain the executed engagement letter with BKD for the audit of the financial statements for the year ended June 30, 2020. The audit will include a financial statement for the university and our affiliated corporations and 3 organizations within the university. So those are UK Research Foundation, UK Mining Engineering Foundation, UK Gluck Equine Research Foundation, UK Humanities Foundation, and the Central Kentucky Management Services Incorporated. The organizational units are UK Healthcare Hospital Systems, Kentucky Tobacco Research and Development Center, and WKY FM Radio. The UK Alumni Association Statement of Financial Position and related statements of activities and cash flows for the year ended June 30, 2020 will also be audited. This audit will be conducted in accordance with the generally accepted auditing standards and standards applicable to financial audits for governmental entities as prescribed by the OMB, Compliance Supplement, Administrative Requirements, Cost Principles, and Audit Requirements for Federal Award Uniform Guidance. The university's primary responsibility is to prepare the financial statements in accordance with generally accepted accounting principles. There's an overview of BKD's engagement fees in the letter. These fees for fiscal year 2020 are approximately $430,000, and that represents a 3% increase over FY 2019 engagement fees of $416,000. If we move to page 44, we have 3 agreed upon audit procedures letters. We refer to them as AUP. The first one on page 44 is the National Collegiate Athletic Association, and that's to verify the accuracy and completeness of financial data of our UK Department of Intercollegiate Athletics. On page 55, we have the second AUP, which sets forth the procedures related to contract compliance between the university and the Kentucky Department of Behavioral Health, developmental and intellectual disabilities as it relates to the management of Eastern State Hospital, and Central Kentucky Recovery Center. Page 65 has it's the third AUP letter, and it outlines the procedures related to UK's contract with the Kentucky Medical Services Foundation. There were no notable changes in the agreed upon procedures for the engagements to be performed this year. Chair Barry, we have Mary McKinley from BKD joining us. She will serve as the partner for this engagement. This is her third year in this capacity, and she will provide the pre-audit report to the Audit and Compliance Committee. But before we turn it back to her, I'll stand for any questions. Okay, thank you.
Good afternoon, everyone. This is Mary McKinley from BKD. I'm hoping that you can hear me. And I also have with me Joni Duckworth. She is the director on the engagement, and together she and I will present the pre-audit report for this year's financial statement audits and agreed upon procedures. We did actually conduct a lot of our planning, initial planning meetings with the UK management, and we drafted this pre-audit report well before there was even a COVID-19 in any of our vocabularies, it seems. Many of this really started back in December and January when we thought things were moving along just as normal in the real world. And so I wanted to give you a little bit of an update with regard to how this COVID-19 impacts may affect our audit process. The good news is that we think that the effects of COVID-19 with regard to the audit and our work and so forth will really be fairly minimal. Even though we have all experienced various uncertainties with the coronavirus in all kinds of ways in our lives, it likely comes as no surprise that there might be a little bit of uncertainty in this year's financial statement audit process. But we think that those uncertainties are really going to be limited to approximately 3 areas. One is the due dates for the submission of our various audit reports, the financial statements, the data collection form, and CPB reporting. We don't know quite yet what the due dates will be. We do have some uncertainties as regarding the testing procedures specific to certain federal awards related to COVID-19 funding, and whether or not certain of those pieces of funding will be included in our federal awards testing, or whether the federal government will exclude certain portions of those from our scope. And then the third area is going to be the effective dates of certain new accounting pronouncements. At this point in time, we are prepared to move forward as if there were no delays in either due dates or effective dates of reporting or any of our testing procedures. And so I think we're in a very good position at this point to be able to conduct essentially business as normal for the most part with regard to this year's audit process. So we do think that likely reporting due dates and certain implementation dates may be delayed, but again, that will just be to our benefit, I believe. What we do know about this process is that we've discussed in multiple meetings with UK's management team and our team all of these impacts, as well as our typical planning procedures. And we believe that both UK and BKD have the tools and the processes and everything in place to be able to just move forward like any typical year. So we're committed to providing you unmatched client service regardless of the COVID-19 effects of things. So with that said, I'll jump into a few prepared slides, and then I'll turn it over to Joni too to help me finish up. The pre-audit report that you do have in front of you, as is typical, outlines our auditor's responsibility for the audit of the various sets of financial statements. This audit process obviously is not an absolute assurance that the financial statements are 100% without error, but it does provide reasonable assurance that they are presented in accordance with generally accepted accounting principles. It also does not relieve this group of its responsibilities to oversee and to govern the group. But what this audit report does outline is that it establishes the scopes of the testing and so forth for the transactions within the scopes of each of these audits. And it outlines the principles used and significant estimates that are made by management inherent in the financial statements. Penny did outline with the discussion. You can go to the next slide, please. Penny did outline these various entities that are covered within our financial statement audits as she outlined the discussion of the engagement letters. So you can see on this screen the names of the various entities, as well as certain other entities not covered in this pre-audit report, but other separately issued audit reports for various of the UK affiliates. Next slide, please. As a part of our typical planning procedures, we do assess various areas of audit risk, and we do that in a variety of ways. We gather information about what might have changed in the processes, the internal control structure during the current year. We look at potential new transactions that may affect the financial statements in the current year. We hold discussions with management and various leadership levels throughout the organization to gather information about where those risks might lie. Consistent with prior years, we have assessed preliminarily our risk areas, and you see those here on the screen in front of you. Those risk areas are very similar to those that you have seen in prior years with regard to the financial statement areas. And again, probably the only thing that may have a little bit of a different spin to the testing process this year could possibly be the uniform guidance. That's where we would test compliance with various federal expenditures and awards. And should the federal government dictate what kinds of compliance work may be necessary with regard to COVID-19 funding, that's where some of the changes may occur this year in our testing process. We have discussed those with the management team at UK, and we believe that these are the areas that we preliminarily will assess as identified risk areas. And at this point, I'll turn it over to Joni Duckworth, who will speak to some of the other aspects of the pre-audit report and our audit services to you.
Thank you, Mary. If you could proceed to the next slide. Oh, I think I'm getting some feedback. Okay. As you'll see in front of you, the slide discusses the timeline and ongoing communication. As Mary mentioned, we are currently planning on the Commonwealth of Kentucky's reporting deadline to be October 2nd of 2020. There may be potential delays, as we've seen elsewhere, with the timing of reports. However, we have not received anything notifying of a delay. So that would result in our presentation to the Audit and Compliance Committee meeting, likely in December of 2020. As with all audits, we encourage you and regular communication between both BKD and the audit committee. And our numbers, both Mary McKinley's and mine, are included within the actual pre-audit communication letter should you need to reach out to us. There are also certain items that would require communication between BKD and the committee, and those are detailed on the slide below. Those would include fraud involving senior management, illegal acts, any significant deficiencies or material weaknesses or material instances of non-compliance with awards that may be identified, or any other matters that you would feel would warrant our attention. And I know the management of the university as well as the trustees have always done a wonderful job in keeping us informed on the day-to-day items, as well as any items that may occur that would warrant our attention. If you could go to the next slide, please. All right. So included here are some new accounting pronouncements. As Mary mentioned, there's currently an exposure draft from the Governmental Accounting Standards Board, or GASB. And this exposure draft is a result of the COVID-19. And they are essentially looking to delaying standards with the most recent one that would be effective for this current year, GASB 84. Fiduciary activities, and they're looking to delay that a year. So standards from 84 all the way through statement number 93 would all be postponed by 1 year. As I mentioned, that is an exposure draft, so nothing has been finalized, but we are keeping in close contact with management in regards to the timing of those standards. GASB 84 would be, if that exposure draft is not made effective, it would be effective for this year, the fiduciary activities. And we've been in many discussions with management and analyzing the impact that that would have to the financial statements. There also is the potential that even if those are delayed a year, that the university would be able to early adopt those standards. So you may see them in your financial statements. I know they're currently weighing their options with everything going on currently. Some upcoming standards, one of the larger ones on that slide is GASB number 87 with leases. And that one will be effective as it currently stands for 2021, although if it is pushed back, it would be 2022. And that is where you'll see a change with the balance sheet and the income statement, as those leases, which may have typically not been recognized on the balance sheet, would become liabilities on your balance sheet. If you could proceed to the next slide. Lastly, as it relates to our consideration of errors or fraud, that's often a topic or a question we receive from audit committees as to how we address considerations of errors or fraud. And you'll see there are several items listed, from engagement team brainstorming, inquiries with management, as well as reviewing significant and unusual transactions. And several of those things have begun already this week as we began our planning procedures. And I know we've had several discussions previously, and we'll continue to have discussions for those planning meetings and any other topics that might arise. That was all of our prepared comments for this time. At this point, Mary and I would welcome any questions that you may have.
Is there any other additional business to come before the audit and compliance at this time? With no further business, do I have a motion to adjourn? Motion made by Trustee McCoy, seconded by Trustee Bowen. Meeting adjourned at 3:42.